Earlier this week, the Reserve Bank Board left rates on hold. The cash rate remains at 4.35%, which is the same as it's been since November last year. What did change is that this time around, the Reserve Bank Board didn't explicitly consider raising rates, unlike their August meeting. The Reserve Bank is still vigilant to upside risks on inflation. They're worried that inflation may not come down as quickly as they would like, but they are now starting to see inflation come down. And indeed, the day after the meeting, CPI inflation monthly indicator was released for August and showed headline inflation fall below 3% to 2.7% over the year. Now, while that's good news, the Reserve Bank's going to be very mindful that some of the reasons for that fall are temporary. Electricity rebates were instituted in recent months, and they have pulled down the price of electricity that people pay. And when those rebates expire, inflation would kick back up again next year. Similarly, the price of petrol has come down quite a bit in recent weeks, but it's not going to keep falling at the same rate. So again, these influences on inflation are temporary, and the Reserve Bank Board is looking for a sustainable return to their 2 to 3% inflation target. That's why they're going to be focusing not just on headline inflation, but also on measures of the underlying trend like trimmed mean. Trimmed mean inflation is still running above 3%. And although it is coming down, the Reserve Bank is going to be looking for more evidence of inflation returning to target before they're willing to start the rate cutting cycle. One of the reasons why the Reserve Bank Board is concerned that inflation might not come down quickly enough is that even though economic growth has been slow and unemployment has been rising, the Reserve Bank still assesses the level of demand in the economy to be outstripping supply capacity. They assess that the labour market is still strong and tighter than you would expect in order to get full employment. They've been mindful that wages growth has been above average, although it will soon slow down, and they've been concerned about the rate of productivity growth. Although the Governor did say that she was a productivity optimist and she did expect this to pick up over time. Here at Westpac Economics, we're very aware that productivity growth in the market sector has actually been growing at a decent clip. And outside of the mining sector, productivity increased in the market sector at 1.7% over the year to the June quarter. But because the public sector has been expanding and public sector work tends to be more labour intensive than some of the work in the private sector, the effect has been a drag on measured productivity. We think that will fade over time, but again, the Reserve Bank has been concerned about supply capacity being constrained and demand outstripping supply, which puts upward pressure on inflation. That's why they're going to be focused not just on headline inflation, which can fall temporarily for some of the reasons that we saw, but also measures of underlying inflation or trend inflation, such as trimmed mean, which is the main measure of inflation they use in their forecasting models. They're going to want to see inflation come down sustainably into the target range of 2 to 3%. That means it comes down and it stays there. That's the trigger that they want to see. They want to be confident that inflation will return to the band. They don't need to wait until inflation is actually in the band in order to start cutting rates, but they need to be more convinced it will happen than they currently are.
The content of this recording is informational and of general nature only and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.